Hi folks, we're here on our YouTube channel again, and we have Mr. Matt Geiger of MJG Capital. Matt, thanks a lot for being on the segment again as usual.
Hey Sonny, thanks for having me back on. Lots of different circumstances than when we last talked, and let's hope things keep going this direction.
I've been keeping track of your quarterly newsletter, and
the most recent one I rolled out was just a couple weeks ago.
Right.
Thanks a lot.
Oh,
that
right.
was a review of the first 6 months of this year, kind of covering this nascent bull market that we're in, and I'm expecting it to continue for multiple years. I think now's a fantastic time to jump on the wagon, and I'll discuss that a little bit more on this call.
Yeah, absolutely. You discussed in your January letter, opportunities are currently available in the natural resource industry that are just astounding. When things turn, they do so dramatically. And we saw that, and you've seen that. You've commented 150 days into this bull market. So what are we experiencing, and what is your partnership experiencing?
Sure. After 4 years of misery, finally seeing a bottom here. I'm 100% sure of that, both in the junior resource space and in commodities and hard assets in general. Basically what we saw since early 2011, and it just got worse over the following years, but production cuts across many different commodities, and on top of that, extremely reduced spending on both exploration and development. So even promising projects that look like they could maybe be economic at reasonable metal prices were either shelved or development was slowed to a crawl. And this happened across precious metals, it's happened in oil and gas and the hydrocarbon space, it's happened with industrial metals, energy metals, really across the board. So what we've seen here, precious metals in particular have run. We're likely to see that strength continue in 2016, 2017, 2018. The precious metals have really led this rally, silver in particular, pretty much the best performing asset class in the entire world across all currencies, commodities, indices, you name it. And the earlier the stage the silver companies, the more they perform. And we have multiple cases of companies up close to 1,000% or even more. So there's really been amazing wealth creation just within these past 6 months. Any investors jumping into the space, whether you're looking at precious metals, industrial metals, etc., should expect a pullback. I still believe that. That said, my suggestion would be to plug your nose, and as long as you can withstand a 20 to 30% pullback, get aggressive right now. And if that pullback comes, you need to hold your calm. We literally went through 4 to 5 years of miserable downturn, and this bull market is just beginning. I'm expecting investors to make a lot of money between here and the end of 2018 to be conservative. This, of course, could go longer, but out of conservatism, in the next 2.5 years, there's a lot of money to be made.
Interesting. And I wanted to talk about some of the factors, that we are in a bull market that you've mentioned in your most recent newsletter. You mentioned 4 of them, and I'll just go through them real quickly, and you can kind of go through the details. One was regarding the metals prices have had a strong run-up. You've seen M&A activity, and also the placement numbers in terms of fundraisings. And general investors are pretty much making money again. So can you go through each of those 4 variables or observations that you mentioned that we are in a bull market finally?
Sure. Well, these are all general points, but I'd say across the board, all 4 of these occurring at the same time is a pretty solid determination that we did bottom in Q1 of this year, early Q1 of this year. Some would argue it happened in the summer of 2015. Those are a bit semantics, but we have touched bottom here. The first point is the metal prices. As I just touched on, silver and gold in particular have absolutely had an amazing year so far. Silver's up close to 50% if you look at the actual commodity, just year to date. And even if you look at the industrials, there have been a couple that have performed particularly well. Zinc at the top of the list, but the rest are mainly hanging in there, consolidating. It looks like there's a full bottoming that's occurred across the space. And I'm not expecting copper prices, for instance, to drop below 2. I think we've seen the lowest prices, at least for this most recent cycle. So that's going to bring good stability, and it's going to help investors evaluate companies' economic studies coming up here, knowing that the prices we're seeing right now are reasonable, and they're not going to be cut in half again over the next couple of years. Moving on to the M&A space, there's been a whole spate of acquisitions, and this is not just in precious metals, it's in industrial metals as well. Some really opportunistic deals. The window's closing a little bit for some of these bigger companies, but I still expect there to be increased spending in the M&A space. In my opinion, probably the best deal of this year, and maybe of the whole bear market in general, was Nestle's acquisition of Timic, just in April, May, and then closed in June of this year. Incredibly opportunistic move by the company. They added what, in my opinion, is the best copper discovery of the past 10 years. If you're a shareholder of Ivanhoe Mine, you might debate that, but in my opinion, this is a top tier, world-class asset, on the same terms as Oyu Tolgoi in Mongolia and some other major copper mines globally. This M&A activity, as I said, will continue, but a lot of the prime, fruits have been picked. So companies, at least majors, are going to start looking, further downstream and, go to the earlier stage companies, because a lot of the top tier deposits are in play or have been bought already. Looking at private placements, the third point you brought up, it's been a flurry of activity across the entire space. Companies that are worthy are coming to market, companies that are not worthy are coming to market, and it's investors' job to be able to discriminate between the two. I would say that, at least for me personally, we've seen more private placement activity just in these first 6-7 months of this year than we did in the entire 3 years before. The companies are really using this opportunity and their uptick in share price to reset their treasuries, get some solid working capital in the bank, and actually begin advancing projects again, which is what you really want from these earlier stage companies. And then, of course, the final point, the most basic, there's been real wealth creation. It's only been happening for 6 months, but people are taking note because some of these moves, and again, coming back to the silver space, have been jaw-dropping. Silver juniors, and especially the explorers, it'd be hard to find one that's not up 400, 500% this year, especially those earlier stage companies. So investors are really running into the space quickly. This has turned a little bit less from a value investment into a momentum play, and investors have to realize that. But at the same time, I think these gains are going to persist over the coming 18 months to 2 years in precious metals.
Interesting, and another thing that you mentioned in your letter was about emphasizing bull and bear markets in a historical context, and you had a really interesting chart by Palisade Global. They had a chart there talking about bull and bear markets in the metal sector, and if you don't already listen to Palisade Radio, they do some excellent interviews as well with Matt, you've also done some interviews with them in the past, but just talk about the chart that they had in your newsletter, which kind of showed where we were at this point in time compared to previous bull markets, and how they compared it in terms of the 5 to 7 year kind of cycle there. Well,
there's two main points, and I think the first is obvious, but it bears repeating. It's that this is a very, very cyclical industry. The extractive resource business goes up and it goes down.
Yeah.
And when things are up, they seem to be going straight up, and when things are going down, they seem to be going straight down. So, some would argue it's the value investor and the contrarian's dream. Of course, you have to be able to survive the down cycle and show prudence when things get too frothy and actually take profit. But it really is, things are either going straight up or they're going straight down. And the other point here, and I'm borrowing a quote from Rick Rule, is that bear markets are authors of bull markets, and of course vice versa. And the point here is that when you see a tremendously long bull market, two things will generally happen. Supply, because of the higher commodity prices, will come rushing online. And at the same time, buyers of these commodities now have to pay higher prices for the same amount of goods. So these twinning effects will always slow down bull markets, especially towards their later stages. And of course, the opposite happens with bear markets. When commodity prices drop and companies are struggling, production gets cut, and at the same time, consumers can now buy what they were getting at X price for half. And so they, in theory, will buy twice as more. So that's what we're seeing here. And I think it's important to take into account the severity of the bear market we just underwent. It's about 1,000 days but it's so steep, and it was really uninterrupted. So there's no periods, even for 6 months, for companies to take a breath of air. If you weren't well capitalized, or you weren't 100% determined to survive, then you really got washed out as a management team, or maybe pivoted into another space and played the shell game. So ultimately, it was completely miserable for 1,000 years, or 1,000 days.
1,000 days.
Thank God.
Well, maybe it surely felt like 1,000 years. Let's put it that way.
A Freudian slip there. Very true. We're 175 days into this current bull market, so this is still very early days. Some would argue that this bull market, just due to the severity of what we just underwent, is going to actually overshoot the bear market we just survived. But out of conservatism, I think it's reasonable to assume that this will roughly match what we just saw. So I think it's not unreasonable to think that we'll see 1,000 days of a general upturn here. Of course, it could end up being 1,500, or it can end up being 800. But especially these early stages, I think we have to understand where we are in the cycle. It's still early. There's still time to get involved.
With the time of tax loss selling, do you expect that to happen again, or is this kind of an anomaly, just the way the market has been for the sector so far?
Well, I'm a long-term investor, so the first point is, I have projections, and of course I have ideas of what I expect the market to do. But at the same time, anybody telling you with pinpoint accuracy what's going to happen is either fooling themselves, fooling you, or both. So it is my belief that in this one case, we will actually bypass the typical tax loss selling. Just given how early we are, this is the first year of this bull market. There's so much momentum going on. I expect if anybody's doing any tax loss selling, other investors will step in and take advantage of that weakness. So I actually don't expect there to be, a major down dip this year. Of course, that could be different. Investors shouldn't base their decisions assuming 100% that that's going to be true. Precious metals should continue to do well, as I said earlier, through 2018, through the end of 2018, potentially into 2019. But they've already moved a lot. So again, more of a momentum play. If you're really looking to be a contrarian, if you're really looking for value, the place to look now is probably in the industrial metals. Zinc has had a move. There's still probably room to go. But, mainstream industrial metals such as copper, tin, molybdenum, the list goes on, have just been completely destroyed in price. And there aren't too many development projects out there that are economic at current prices. So it depends how you want to play it. If you want to be more conservative, go for the lowest cost curve projects, the ones that you think can make money at current prices. If you want to get particularly aggressive, you can look at the optionality plays. And people that have done that for precious metals have outperformed anybody in the space. Again, optionality plays are looking at a deposit that is uneconomic at current prices. But the idea is if you're very, very confident in a 50-60% rise in price, maybe more, you bake that into your model, and suddenly something that is worthless today can be worth hundreds of millions at a different price. Again, more risky, more aggressive, but that's a good way to create tremendous wealth. And I think that's a decent strategy if you have the stomach for it in some of those aforementioned industrial metals. And then the final one that's really a contrarian stream right now is uranium. That's one of the few commodities that's actually down here today. Things look ugly. There's negative articles coming out. People are reaching out to the actual LPs saying, how exposed are we to uranium? I'm scared. And that to me is actually a bullish sign, showing that general sentiment is so ugly that it's a good opportunity. You had Cameco come out with very disappointing quarterly results.
Right.
You have news, especially in the United States, of nuclear reactors closing. And for U.S. retail investors, this is generally the news they're seeing. They're not seeing the news about Japanese reactors being turned back on, or the tremendous amount of reactors that are being planned for construction in China, Saudi Arabia, et cetera, et cetera. So I really do like uranium. No reason to rush in, but if you can start tiptoeing into the space over the next 6 months, and you have the fortitude to hold until late 2018, early 2019, I think you're going to do sensationally. There aren't too many names in that space. There aren't too many vehicles to play uranium. And if you pick right and have patience, I think uranium prices will catch up towards the end of this bull market and actually outperform in the latter stages. And investors can make a tremendous amount of money, but should only enter into that trade if you're really, really confident about the long-term demand from uranium like I am. Interesting.
Okay, well, thank you so much, Matt. If you want to find out some more information on the partnership fund, you can get in touch with Matt directly at his website, mjgcapital.com, and you can talk to him directly. And also, I strongly encourage you to follow him and actually read his quarterly newsletters. They're very informative, and you'll learn a lot. And you can also talk to him directly if you have any questions. Matt, thanks a lot.
Thank you, Sonny.